The last 72 hours in crypto have been brutal. Bitcoin plunged from fresh highs into a violent downside move that briefly took the price into the low six-figure range, roughly around $110,000 to $116,000 depending on the exchange, as traders rushed to unwind highly levered positions. That squeeze wasn't small. Multiple outlets are tracking massive liquidations across derivatives platforms, with headline figures in the single and double-digit billions of dollars as positions were forcibly closed and stop-loss cascades fed on themselves. What sparked the panic? A sudden wave of macro headlines, trade war rhetoric and tariff threats that rattled risk assets, combined with thin liquidity in parts of the derivatives market, produced a 1-2 punch. That combination amplified losses and produced a historic spike in forced selling and trader liquidations, with several reports estimating billions wiped out in very short order. Markets hate surprise policy shocks. When they hit an already momentum-driven market like crypto, the result is accelerated downside and a brutal washout. In today's video, we walk through what this carnage means for crypto investors and the scenarios that could return crypto to a durable uptrend. We'll also hear direct, unfiltered commentary from Raoul and Tom Lee. If you find this useful, hit like, subscribe, and leave a comment. Thanks for tuning in and enjoy the video. Let's begin with recent tweets from Real Vision CEO Raoul, in which he reacts to the recent pullback in the crypto market and various narratives that have been flying around about the ongoing crypto bull market. In his first tweet, Pal addresses claims by investors and even some top experts that we are in a tech bubble, headed for a massive dot-com bubble crash. The tweet reads, "No, it's not a bubble in tech stocks. We are less than one standard deviation from the trend. You can see what a bubble looks like in the late 1990s when we exploded out of the decade-long log regression channel to be multiple standard deviations from trend. Nothing to see? Move on." Pal's core argument is that we shouldn't conflate high valuations with runaway bubbles. During the dot-com mania of the late 1990s, equity valuations didn't just rise. They detached from their historical trajectory entirely, soaring multiple standard deviations above trend. Today, even after a decade of strong performance in tech, the Nasdaq remains within one standard deviation of its long-term regression channel. That means the market's growth, while fast, is still within the boundaries of historical norms. For seasoned investors, this is an important distinction. Elevated valuations do not automatically equal speculative excess. As long as prices move broadly in line with productivity and liquidity growth, the system can sustain higher multiples without entering bubble territory. He went further, addressing the argument that P/E ratios prove we're in a bubble. Also, but P/E ratios are at bubble valuations. Narrative doesn't take into account the fact that during debasement, the P rises, due to debasement, more than E, anchored by GDP growth in general. If debasement is 11% and GDP is 2% trend over the same period, then PE rises by 9% per annum. This means that P/E ratios double over 8 years or so. It's the denominator effect. Here, Pal introduces the denominator effect. In a regime where monetary debasement is running far ahead of real growth, asset prices, the numerator P, can inflate faster than earnings, the denominator, E, structurally pushing up PE multiples over time, without that necessarily signifying an immediate bubble popping. He suggests that part of today's high multiples may simply reflect the mechanics of monetary policy, not delusion or mania. Turning directly to crypto, Pal draws analogies between Bitcoin's performance and the macro cycle. Also, Bitcoin is less than one standard deviation from trend. It usually hits 2 standard deviations. This is driven by the ISM business cycle being lackluster so far, which in turn is driven by less need to add liquidity in the US due to most debts extending to 5 years and needing to be rolled over within the next 12 months. $10 trillion. Thus, the bulk of liquidity is delayed, and forward-looking indicators suggest it lies ahead. Financial conditions give us a 3-month lead, and that in turn leads ISM, and that all drive number go up. NDX has a slight premium currently, but that is normal at this phase. Pal argues that Bitcoin, like tech stocks, remains close to its long-term regression trend. Historically, each major bull run has extended roughly 2 standard deviations above that trend before cooling off. The fact that we're still within one suggests the current drawdown may be temporary rather than terminal. The reasoning ties back to the macro cycle. Powell connects the lack of explosive upside to the business cycle indicator known as ISM manufacturing data, which reflects how much liquidity is flowing through the economy. Because many U.S. debts were refinanced during the zero-rate era of 2020 to 2021, their maturities were extended. That pushed the next big wave of refinancing, and thus liquidity creation, further into the future. Until those rollovers begin, liquidity growth remains subdued, keeping risk assets like Bitcoin in a holding pattern. But once those maturities start to hit, the system will need new liquidity injections to absorb them, the same liquidity that eventually drives number go up. Powell then zoomed out to the bigger picture, linking crypto, equities, demographics, and debt into one interconnected cycle. And Bitcoin usually decouples to the upside too at this point in the cycle. NDX, which you call a bubble, has a correlation of 96%, and Bitcoin 90%, which makes total global liquidity the most dominant macro factor, maybe in the history of markets. This is driven by demographics, which drives debt, and debt drives liquidity via debasement. But this time in the US, rates are too damned high, and that means we really need to allow liquidity to fill the void. And to us, that is why the cycle is lackluster thus far. Because 2025 was not the year of the big debt rollover. Thank you, COVID, for allowing average maturity to be lengthened by a year as rates hit zero. So, probabilistically speaking, things have shifted. These tweets capture the essence of Powell's macro worldview. He sees global liquidity, the combined effect of central bank balance sheets, private sector credit creation, and sovereign debt issuance, as the single most powerful force in asset pricing. The fact that Bitcoin and the Nasdaq move with correlations above 90% underscores that shared driver. He also highlights an under-discussed consequence of the pandemic. When governments and corporations extended their debt maturities during the 2020 zero-rate environment, they unintentionally delayed the next wave of liquidity injections. High interest rates now act as a temporary dam, holding back the flood. Once the rollover cycle resumes, liquidity will surge again, potentially igniting the next leg higher for both tech and crypto. In Powell's eyes, that isn't speculation, it's a predictable sequence in the rhythm of the debt cycle. Finally, Powell offered his personal strategy for navigating this uncertain phase. "I am fully aware that this time is different," is a powerfully dangerous sentence, but our view at GMI is that it is not different. It is the same because the cycle is based on debt maturity. Still, taking lifestyle chips off into a strong rally to new highs in Ethereum, Solana, Sui will hedge the risk of being wrong. I never go through the cycle with no exposure, but instead prefer to compound and add when prices fall. To me, it's all to play for. There are no bubbles. It's a nuanced message, one that balances conviction with humility. Powell recognizes that every investor feels the urge to say, "This time is different," but insists that the underlying mechanism hasn't changed. Debt maturity and liquidity timing still drive the cycle. His approach is to stay exposed but not reckless, to take profits during strong rallies, rotate into quality altcoins that outperform in liquidity surges, and add to positions on pullbacks like the one we're experiencing now. This mindset separates the trader chasing peaks from the investor compounding through cycles. Powell doesn't see bubbles, he sees time horizons. The longer liquidity stays constrained, the more potential energy builds for the next expansion. Tom Lee, chairman of BitMine and co-founder of Fundstrat Global Advisors, has also reacted to the recent crypto market carnage, noting that the weakness might not be something to worry about. In a recent post, Lee shared insights from his colleague Mark Newton, Fundstrat's managing director and global head of technical strategy. The tweet reads, "I do not make much of crypto weakness in recent days and expect Ethereum likely bottoms out over the next 1 to 2 days before heading back higher and rallies to $5,500. Following a recent strong technical rally from 9/25 into 10/7 in Ethereum, there's been a minor 3-wave pullback, which is expected to likely end by 10 out of 11 and turn back higher. Ethereum has already corrected 50% of this recent rally from September 25th, but is expected to possibly hit $4,200 to $4,220, which would provide an optimal area of support before Ethereum turns back higher. The tweet reflects Lee's cautiously optimistic outlook on the crypto market. He's long argued that investors often misread short-term volatility as weakness, when in fact, it can be a technical breather, a moment for markets to reset before resuming their upward momentum. Newton's breakdown highlights precisely that dynamic. After a strong rally in late September, Ethereum has been consolidating in a textbook three-wave corrective pattern. According to his analysis, this correction, now approaching the 50% retracement mark, is likely nearing completion. The 4,200 to 4,220 support zone could serve as a critical pivot point where selling pressure exhausts and bullish momentum returns. For Lee and Newton, this setup suggests that Ethereum's path of least resistance remains to the upside, with the next target sitting around $5,500. In essence, while headlines may focus on price dips, the underlying technical picture, when read through the lens of seasoned strategists, still points to strength and continuation. In another recent post, Lee also reacted to widespread speculation that today's market is just like the dot-com boom of the late 1990s. His post reads, "To us, we are watching for signs of excess exuberance, which characterized the 1999 period, but no signs yet." It's a sentiment that fits neatly with Lee's broader outlook, one that sees current market strength as justified by fundamentals rather than driven by hype. And when paired with his colleague Mark Newton's technical analysis of Ethereum, which points to a likely rebound toward $5,500 after a temporary pullback, a clear narrative emerges. The crypto market is still in the early to middle stage of a powerful uptrend, not the euphoric peak of a speculative bubble. This perspective also resonates strongly with Raoul Pal's recent analysis. Pal has consistently argued that we're entering what he calls the exponential age, a phase where digital assets, AI, and technology converge to drive a structural shift in global capital flows. He believes that while markets may appear overheated to casual observers, the real story is about network adoption, liquidity expansion, and the macro transition into a new digital financial era. In Pal's view, these aren't signs of irrational exuberance. They're the natural byproducts of a transformational cycle. Together, Lee and Pal offer a refreshing counterpoint to the bubble narrative. Where mainstream commentators see danger, they see opportunity grounded in data, structure, and cycle awareness. The message for investors is clear: stay informed, not fearful. Volatility may shake out the impatient, but those who understand the underlying trends, as voices like Tom Lee, Mark Newton, and Raoul Pal remind us, recognize that true wealth is built during moments of doubt, not euphoria. If you found this analysis helpful, make sure to like, subscribe, and turn on notifications so you don't miss our next deep dive into the ideas shaping the future of crypto and global finance. Thanks for watching, and see you in the next one.